So welcome everybody to the next in the Tutors Association's summer series of training and support. So today we're going through accounting essentials for tutors, and we're really lucky to have Stephen Perry, who's actually the TTA's accountant, who does a fantastic job for TTA, and has got a lot of expertise and knowledge of accounting, and in particular the tuition sector. So without much further ado, I'm going to pass you over to Stephen's very, very capable hands and allow him to take you through some of the things you might need to consider it from an accounting perspective, and also then give the opportunity to ask any questions. Obviously, if you need formal accounting advice, then it might be the case that you need to go to your own accountant or get an accountant if you don't have one. But general queries, I'm sure Stephen will be able to handle. So just to be clear, obviously there's a caveat here, which is that Stephen's not giving formal written advice. If you need formal advice on how to structure your business, then you'll need to go to an accountant. But hopefully you'll get a great overview today, and it'll be really helpful for you to at least make the first steps in terms of planning how you structure your tuition business. Okay, over to you, Stephen. Thank you very much.
Thanks, John. Just checking everybody can see the slides. If anybody can't, do let us know, and I'll press on. Just a quick bit of background. I own an accountancy practice based in York. I've been in the accountancy world for over 35 years. Most of that time I've been in professional practice or in the PLC world. I've been in this sector primarily for about 15 years now, and been with the TTA for both as an accountant and as on helping with our board for a few years. The purpose of this webinar is to give an overview of the sort of essential aspects of accounting for tutors. It's not designed to be a technical webinar as such, but we can put on a technical webinar later on if there's specific questions that people are struggling with. And it's assuming a reasonably basic level of knowledge. So what I'm going to try and cover today is a number of the things that commonly asked or we commonly come across when helping people either start a business or get an accounting system in place, or try to deal with some of the basic elements of bookkeeping, accountancy and tax. So if people on here are already experienced business owners or handling their own finances very well, you might find some of this quite basic, but if you do, then do bear with us and ask questions. There should be plenty of time for questions at the end, so I will press on. So the purpose of the webinar is largely to explain how to effectively manage your business's finance. I'll cover the basics, sort of an introduction to the difference between bookkeeping and accountancy, some basic tax facts, and some compliance and regulatory issues that will come up, and we'll try and deal with that in the context of those that are most commonly come up in this particular sector. So if that's okay, I'll press on. I'll just explain my lack of skills with Google means that I can see either my slides or the attendees, but not both, but I'll work on that. Just some background on bookkeeping. So this is an area that's often overlooked, but it is vital. It's the underpinning, sort of the basis of all the accounting data that we generate, and whether that accounting data is useful is largely down to the quality and accuracy of the underlying bookkeeping. So it's an area that tends to be treated as a technical level, sort of junior level within the accountancy world. It's not at all. It's absolutely vital to the quality of the work that we can produce beyond that, particularly in terms of decision making, tax planning, and so on. And the definition of bookkeeping is primarily just maintaining the business's accounting records. So if you employ a bookkeeper or you have a bookkeeper working for you, that's their job. Different bookkeepers draw the line as to how far they take that work, but the conventional cut-off point is if you're maintaining a set of accounts, what's known at the end of before you start to prepare year-end accounts or management accounts, what's known as the trial balance is usually where the bookkeeping work stops and the accounting work starts. But bookkeepers that work for me and I work with, we expect them to do all of the data entry, reconciling things like the bank account, make sure the bank per the accounts ties back to the bank statements, check debtors and creditors, check the posting of income and expenses, so the chart of accounts and the accounts that you produce reflect the underlying transactions, and do that to a high level of accuracy. There isn't in this country any actual requirement to maintain accurate accounting records, but if you unlike in Germany, where it's a legal requirement to maintain accurate accounting records, we maintain them to what's often referred to as a true and fair view, or what helps the reader of the accounts. But I would strongly recommend aiming for a high level of accuracy, because that leads to better decision making, easier compliance. If you do have an HMRC inquiry, which is something we deal with quite a bit, so we can touch on more later, then it certainly makes the inquiries easier. And in terms of process, maintaining your accounting records is something that's easier and simpler to do if it's little and often. If you do it one big fell swoop at the year end, it's quite a time consuming and difficult process, and often people have forgotten what's happened during the year, but little and often means that it's easier to keep on top of. So that's where the accounting system as such starts, with the quality of the underlying records. In terms of bookkeeping systems, what works depends on the size of the business. So the common ones we work with are QuickBooks Xero and Free Agent. They all work up to businesses, probably turnover wise up to several £1 million before you need to start looking at more enterprise level software. But from the very basics up to several £1 million, the standard SME bookkeeping systems are absolutely fine. There is nothing wrong with keeping your books manually. We don't recommend it, people do, but it's perfectly acceptable to keep your books in hard copy form. But HMRC and Companies House and auditors are all perfectly happy these days with everything being digital. In terms of how to think about the bookkeeping system, we try to find that it's easier to think in terms of your income and expenses being two separate things, than tracking your invoices and receipts as being a separate process. And in terms of tracking invoices and receipts, I'll touch on it more later, but there's quite a wide range of OCR scanning sort of digital receipt capture systems out there. QuickBooks has one built in. Xero has a sort of a bolt-on one called HubDoc. But if you come across receipt capture systems like Dext or Apron, they all do broadly similar things to a greater or lesser extent, depends what you're prepared to pay for. And you need a separate method then for tracking assets. So fixed assets, cash, debtors and creditors, which are your key balance sheet items, need to be tracked and the movements on those recorded, so that at the end of the financial year or the end of the month, when if you want to do your accounts, you've got a method for knowing how accurate they are and what work you need to do to get those up to date. Could I just check, John, can everybody see the slides okay?
I can, but has anyone got any issues with the slides? No? Thumbs up? No? Sounds good. Thanks, Stephen.
Okay. Moving on from bookkeeping, the work that is often defined as accounting is largely the financial statements, which is traditionally known as the profit and loss account, which is the statement of income and expenses, the balance sheet, which is your statement of assets and liabilities, and the cash flow statement. The way to think about these, if you're not familiar with accounts, these three as concepts, is there's a profit and loss account is movements in and out during the year. The balance sheet is where you are at the end of the year, and the cash flow is how the cash has moved. So accountants tend to think of these three as one and the same thing. They're presented separately, and often people forget to do the cash flow statement because it's not a requirement if you're running a small business. If you're running a large business, it is a requirement to produce a cash flow statement. And most finance directors will just think of these three as one item, because they're three different parts of the same story. And if you think of them together as one item, then it gives you a better overall view of how your business is performing, rather than simply focusing on whether or not it's making a profit or a loss. You also need to consider whether it's got net assets or net liabilities, and whether it's generating cash or absorbing cash. A focus on one, but whilst ignoring two of the others, means that you get a very lopsided view of the business's performance, and that can hinder decision making. But you can't consider whether a business is profitable or not without considering whether it's absorbing cash and generating debt, and whether it's you can't consider whether the business has got strong net assets without considering whether or not it can realise those assets and spend them. So if your business is largely represented by assets, but those assets are property or machinery, and you can't spend those, then and it's not generating cash, then your business is going to struggle. So that's a very basic introduction. There's quite a bit more we could talk about there if we want to. In terms of managing income and expenses, I would start with tracking income from the tutoring business, who you're billing, when and how. If you haven't got a billing system, it's quicker and easier to do that through some sort of software. But we do work with plenty of people who are invoicing on Word or Excel, but there's the basic bookkeeping systems normally have billing built in, and all of the main tutoring platforms support billing as well. But then how you categorize and record your expenses and how you get the data attached to those expenses, whether it's a digital image or invoice sitting in a filing cabinet, there's no particular prescriptive way of doing it. There are conventions, but in the UK, the way we record accounting information is largely driven by what's most useful to the end user of the accounts, which in most small businesses terms is the owner. Where you can find that useful is highlighting areas where you think you can improve profitability by reducing expenses, and working with an accountant can help you do that, but most small business owners can work that out for themselves. One, if you're starting out or you're a sole trader, the area that tends to trip a lot of people up is not having a clean and a complete separation between your personal and your business expenditure. And by that, I tend to mean people either taking money out of their business account, using it for personal purposes, which are not wholly and exclusively for the purpose of the business, or putting money into the business without keeping track of it. And we try to encourage our clients to keep as clean and a complete separation between their personal lives and the business lives as possible. Quick overview on invoicing and payments. So invoicing of customers, it's a legal requirement. We strongly recommend ensuring customers understand your terms and method of payment, so how you want to be paid, what's the easiest way for them and for you to do it, what your payment terms are, and then how you deal with late payments. Do you add interest to the invoices? Are you chasing? Are you expecting to give credit terms, credit length? And if so, are you using any kind of software? If you've got a lot of customers, do you use software to track credit control, who's paid when, and have an automated email trail for following up? And do you treat billing your customers part of the service? It's often treated as an admin expense or an admin overhead, but it's actually a core part of the service. And how you present and how you position your invoices and the way that you interact with the customer is probably one of the most important things to them. So it becomes by default one of the most important things to us as business owners. And we try to encourage people to put an effective and clear process in place with trigger points that says that, for instance, if you set 30-day credit terms on your payments, customer's not paid, then that escalates into some sort of chasing or legal process, and how far to take that. But it's much easier to define how you'll deal with that in advance than it is to try to come to it when there's a problem, or your customers stop paying, or you're running into issues with trying to collect outstanding overdue payments. We're going to give a quick overview of tax. This isn't the tax webinar as such, but hopefully everybody's familiar with the three core taxes that will impact on the business, which are income tax, national insurance, and VAT. And if your company, the income tax effectively becomes corporation tax. Both income and corporation tax are assessed by way of self-assessment. The government has been talking since 2016, if I remember rightly, about doing away with the tax return and moving to making tax digital, and has so far not managed to achieve that for income or corporation tax. They have managed to achieve it for VAT returns, but at the moment we're entirely reliant on the taxpayer sending HMRC their version of events for income and corporation tax. HMRC then decide whether to accept that or whether to launch an inquiry. Just touching briefly on inquiries, if you're not familiar with the subject of HMRC inquiries, they have the power to seize or review or get hold of any information that they think is relevant to how you run your business. If you're on the receiving end of inquiry notice, I would strongly recommend getting an accountant involved, because it can get quite complex quite quickly. But HMRC's powers are pretty pretty thorough and complete, and they tend not to put very long deadlines on. But if they have launched an inquiry into your business or a business you're involved with, once you've engaged with them, they do often then accept that it's going to take a while to get the information together. They tend to be flexible and usually happy to negotiate. They tend to launch inquiries on themes. So hopefully the tutoring as a sector isn't a theme they're interested in at the moment. But if they do decide that tutoring as a sector is an area that they're going to have an interest in as a theme, they're likely to send an inquiry notice to everybody. So we could end up with everybody having an inquiry at the same time. But they, at the moment, picking on influencers and content creators. So quite a few thousand influencers, Instagram people mainly, are currently being investigated by HMRC. In order to keep track of returns, key dates and deadlines are vital, and also an understanding of what's allowable and what isn't. The general principle, for those not aware of it, is defined in the legislation as wholly and exclusively. So if you're not sure if an item of expenditure is allowable for tax, the question is it wholly and exclusively for the purpose of the business? If you can't say that for definite, it's not deductible. And quite a lot of things have an element of private use, and if they have an element of private use, you can't then deduct it for income or corporation tax. There's a lot of, this is where tax law becomes interesting, and where it also becomes quite contentious, because that's the area that HMRC are usually most interested in. Just briefly on VAT, it's compulsory if you hit the threshold and don't have an exemption. So tutoring is in your own name through a sole trader as a self-employed tutor is currently exempt from the requirement to register for VAT, but if you're trading through a company, it's not. And the turnover threshold is mandatory at 90,000. How that 90,000 is judged is on a rolling 12-month basis. And we're supposed to register companies for VAT and anybody else that doesn't have an exemption in the month in which they hit the threshold. So in order to know if you're heading towards being VAT registered, the measure is to take a rolling 12-monthly basis, move it forward by a month each month, and track where you're heading, and then register in the month in which you hit the threshold. At the moment, registering for VAT is actually quite a time-consuming, lengthy process, mostly because HMRC are a long way behind with their paperwork, and it's taking them months to respond. And then they ask lots of questions, and then they reject applications, and it's becoming quite messy. But those are the general principles. So you're legally required to register for VAT when you hit the threshold, even if it takes HMRC a few months to think about whether to issue a VAT registration number. Once registered, then filing either quarterly or annual returns, depending on whether the scheme you're in. It's no longer possible to submit VAT returns directly through their website or through any other means than commercially approved software which is registered with HMRC. And that generally means, in our world, QuickBooks or Xero or one of the common bookkeeping systems. It is worth bearing in mind as well that depending on your turnover and where you are with the business, there are a number of different VAT schemes. So the standard measure is you pay 20% of your income over as VAT, recover 20% of your costs where it's eligible. But there are other schemes. The flat rate scheme can save a lot of time, admin and bookkeeping wise, because it's just a fixed percentage of your gross turnover. So with the flat rate scheme, you're still charging VAT, charged 20%, but a fixed percent of that 120% figure becomes payable to HMRC. You don't need to then recover or account for the VAT on any of your expenditure. And we also find people benefit or can benefit from the annual accounting scheme, which allows for advance payments, and that's just a monthly payment in advance with a truing up exercise at the end of the financial year. So if you're not registered for VAT, or you are registered for VAT and fall within the turnover thresholds for the schemes, it's worth having a look or having a chat with your accountants about any that might be suitable. I didn't want to go into too much detail on business models, but be familiar with the difference between the employment business and the employment agency. With the employment business, you're charging the customer in full, you're engaging with the client, paying the staff or paying the team members, and then responsible for the VAT on the full element of the service. If you're an agency, you're not engaging directly with the customer, but you are charging VAT on the commission element, and then the invoicing is direct from the tutor to the client. But we can talk more about business models at the end, but they both require a level of accurate invoicing and record keeping for compliance purposes, keeping the distinction between the two very clear in your own minds. And then there are the tutoring platforms, particularly things like Tutor Country, do a good job on the employment agency model, if that's the one that you're running. Legal requirements for record keeping, currently 6 years for everything. HMRC are quite happy for everything to be kept digitally, but that requires you to keep all your invoices and receipts, bank and credit card statements, all your payroll and pay-as-you-earn reports. And then it's a good idea to keep hold of company secretarial information. If you're running your business through a company, it's a good idea to keep board minutes, resolutions, and a record of key decisions, as well as the usual changes in directors and shareholders, registered office, and so on at company's house. Partly because it provides evidence of decisions, and also because it provides, in the event that there are any issues, disputes, or problems with HMRC, evidence that the compliance aspect of the way the company is run is up to a standard that they can take some assurance from. Moving on from bookkeeping and accounting to things that often fall within the realm of the finance director or the business owner, it's useful to keep a business plan, look forward to where you want the business to go, create a budget or a forecast for where your income expenditure is going. We always recommend people keep cash flow forecasts, because cash can move at different rates and at different times to income and expenditure, resulting in potentially the business going bust. The most common cause for business going bust is running out of cash, not being unprofitable. And that's just often a timing issue. The difference between a budget and a forecast. So budgets are often used to set in stone the framework in which the business is operating for the year, which is usually used to control expenditure, but is a good guide to what the business can and can't achieve that year and what needs to change in order to make it achieve it. Whereas a forecast is a restatement of where the business actually is and where it's actually going. And in large corporate organisations these days, most decision making is based on the back of rolling forecasts. So the budget's not very common, particularly in large organisations, just because things move too quickly to make it useful. But all large organisations run a cash flow forecast, sometimes down to daily. I've run daily cash flow forecasts for large organisations that have been in trouble, and then make decision making based on the fallout from that. The thing that tends to catch small business owners out is not saving for tax, which sounds obvious when you say it, but it's surprising how many clients we tell them to save for tax and we tell them what the tax is likely to be, but they still often quite surprised to find that if they're not being taxed at source through pay-as-you-earn, that they're responsible for finding the cash and paying the tax over. Briefly on, do you need an accountant? Technically, no. You don't need an accountant to help, but it certainly can, particularly if you're not comfortable with the compliance regimes that HMRC and Companies House have in place. Accountants are particularly helpful in setting up systems so that you do keep accurate records. The one area that is more difficult to do yourself is payroll, just because the issues around employee pay, and payroll is the one area that has to be right. Preparing year-end accounts and tax returns and VAT returns gets complex and is a skilled job. Where an accountant can particularly help is the more forward-looking decision-making side around management information, helping with KPIs, budgets and forecasts, and looking for areas to improve profit. And often, as a profession, we'll try and bundle that up into one thing, so you can, if you're a big business, you've got an in-house team, you've got a finance office. If you're a small business, but you still need someone operating at each of those levels, so you need a few hours of a finance director, but you only really need a few hours of a bookkeeper as well. It's difficult to find somebody who can do both at the same time and is comfortable doing both at the same time. So we tend to recommend mixing that up, and an accountancy firm will usually be able to put together a team to help who do the different aspects of the job at different levels at different times. some resources worth looking at. HMRC have launched a while ago now. They launched a YouTube channel, but it is extremely good. It's all animation and it's pretty good. Companies House send out regular newsletters and updates. They tend to be quite technical. The accountancy bodies, I think you need to be interested in the subject and in the accountancy body itself and what they're saying, but we can provide guidance on what the accountancy bodies are seeing. The online accounting tools, particularly QuickBooks and Xero, both have very good webinar programs that are free to their end users. Well worth looking at them, and also at their blogs. And the TTA itself has a lot of information on its website that's quite useful, and particularly around the business model and tax. So those are the key things. So the issues for me are largely get the basics right in the first place, get the bookkeeping accurate, put in a system that ensures that you do that on a regular basis, and keep working on the bookkeeping so that the underlying data is correct. Then the financial statements that overlay that will look more reasonably sensible, less queries, fewer issues to resolve, greater level of compliance. And I think that's everything I wanted to cover, John. So happy to take questions.
Thank you very much, Stephen. That's very, very helpful. And hopefully everyone else found it useful. Has anyone got questions in terms of accounting, business structuring, budgeting and profit and loss, all this kind of thing? Have we got any questions? Feel free to either put your hand up at the bottom or to come off mute and just pipe up. No questions at all? Is there one in the chat? In terms of using a business bank account for a tutoring individual, is the best thing to do to pay a monthly salary into a personal account?
If you're... Sorry, could you just repeat the question, John?
So it's in the chat. It's a Joy Murphy said, in terms of using a business bank account for a tutoring individual, I believe that means you're a sole trader, is the best thing to do to pay a monthly salary into a personal account. So I think it's about separation between personal and business funds, in particular when someone's a sole trader. Obviously, they're the same legal entity.
Yes. Yeah. If you're a sole trader, then anything you take out of the business that's personal drawings rather than business expenses is taxable. So that counts towards your personal tax threshold. And effectively, it's the way it works is the opposite. It's counted. You get your income less your business expenses, gives you your profit, but then a sole trader's personal tax return will add back drawings, which is the amount you take out as a salary. A sole trader still gets the 12,570 tax-free threshold, but you're paying tax on the basis of your personal self-assessment tax return, which includes an income and expenditure from the business. So the business yourself are the one and the same tax-paying entity. So how you separate it out for cash purposes, I would recommend taking the personal salary. It doesn't really matter whether you take it out to a business bank account or not, to be honest, at this stage. But the key thing is that you take out the amount that you are going to have to pay for tax and keep that separate. So there's a saving for tax in there as well. From a record keeping point of view, if you're wanting to track how the business is performing, definitely better to keep the two separate.
Thanks very much, Stephen. Cash or jobbins, if you doubt you'll hit the £12,570 limit for the year, do you need to set aside anything for tax or NI? And I don't know if this relates at all to self-assessment as well for individuals.
The short answer is yes, but the rate has changed. So if you're not going to hit the income tax threshold of 12,570, you may still go over the national insurance threshold. But if you're a sole trader, the government has abolished Class 2 national insurance. So just a quick overview on national insurance. So if you're employed through pay-as-you-earn, everybody employed pays Class 4 national insurance. If you're self-employed, you pay Class 2, but the government abolished it and also reduced the rate on Class 4. So there is still a need to check when you hit the other class of national insurance thresholds, which are roughly about £6,000 a year if you want to keep your state pension entitlement at about £9,000 a year if you're then required to start contributing to national insurance. But I have a feeling that that's all going to change again before too long. It's not very much, and it is possible. HMRC and others do have online calculators that show how that works, but the short answer is yes, you will still end up paying a little bit of national insurance if you're under the tax threshold, but over those two limits.
Thank you, Stephen. Yeah, and I was just about to ask, is there a suggestion that this might not be very permanent in the current tax situation, given that we have a new government and they might decide to do things differently from how previous governments have done things? Okay, do we have any other questions at all in relation to accounting and tax, whether it's for a business, sole trader, limited company? So we've got another question. Is it right that you don't need to do anything for the first year? E.g. April to 24, 25 isn't done until October 25. So this is about timing of when you've got to do things and when how that relates to the period in question.
Yes, yeah. So if you're a sole trader business and you're just starting up, the rules have just become a lot simpler. So there used to be something called the basis period, where for the date you started trading for the first 12 months, that effectively formed part of your first year accounts. But the government's abolished the basis period, and the reform and the transition from the basis periods to just operating on the tax year is going to make life easier in the long run for everybody. So the tax year runs from the 6th of April through to the 5th of April. HMRC more than happy to take that as meaning the 31st of April to the 31st of March. So if you don't want to worry about the additional dates, if your first year of trading for accounting and tax purposes ends on the 5th of April, your first tax bill isn't due to the 31st of January the following year. After that, it does get a bit more complicated depending on whether you're brought into the payment on accounts process. But for most people, tax is due January following the end of the tax year in April. And then for the year after that, the expectation is that you make a payment on account in January of 50% of the estimated following year's tax. And that second payment on account, the following 50%, is due 31st of July. The way to, if you think your earnings are fluctuating up or down and you want to adjust the payments on account, that's quite possible, but you do have to send HMRC a figure and tell them what you want to pay by way of a payment on account. The payments on account regime does cause a lot of confusion for a lot of people because it's not straightforward, but in terms of deadlines, those are the key ones. So tax is due 31st of January and 31st of July. And the 31st of January figure is the point at which you finally declare that's how much my tax is for the previous tax year ending the previous April. If you run a company, it's slightly different. So the company's financial year end is whatever you've agreed with Companies House, and then tax is due 9 months following the end of the financial year.
And is there no payment on accounts for companies then?
There can be. There is an interest. The way the government structured interest in terms of if you pay in advance is if you owe HMRC money, they charge you interest now at bank base plus, I think it's 2.5%. So it's about 7.75% is the amount you owe them. But if they owe you money, it's bank base less 1 or 2%. I can't remember the exact figure, but it's not very generous. So if you do pay on account early, HMRC will pay interest on the balance, but you'd be much better off leaving the money in the bank.
Perfect. Thank you very much, Stephen. Any other questions relating to accounting? No, I thought it was all very clear, and it seems like most people seem to have agreed. Did everyone find that useful? Was it pitched at roughly the right level? Was that sort of based on? Yeah, got a thumbs up. Perfect. Well, if no one else has got any questions, we can close the meeting shortly. Any other questions at all? No, brilliant. Well, thank you very much, Stephen, for a very concise and very comprehensive overview of the of the accounting principles for tuition businesses. If anyone has any questions, then obviously TTA can support with accounting issues to an extent, or especially regarding compliance and regulations, things like that. We do engage with HMRC and various other agencies on behalf of the tuition sector generally, and they do sometimes come and attend our National Tutors Conference in October. So if you do have any queries, the conference in October is definitely somewhere I would recommend you go to try and get answers, because often we'll have government representatives there as well. And we usually have an accountant, at least one. I know Stephen was there last year, and at least one VAT consultant. I believe we've got Mike Payne, who is a specialist VAT consultant next year as well. Or this year, sorry. So if there's no other questions, thank you very much, everyone, for attending, and we look forward to seeing you at one of our summer sessions soon.